In this video, guys, we're going to break down order blocks, and what an order block is it's the last opposite moving candle before the break of structure. So if I were to just, again, drop a diagram here, and we have price, again, moving to the upside, boom, higher high, higher low, higher high, higher low, so on and so forth, right? Now, the last opposite moving candle, so in this example, if we had price print we'll do a red bearish candle right here. You know, this is the last down moving candle before the move that ended up breaking structure, correct? So the way we would anticipate a potential entry would be price could come back and fill any fair value gaps, any imbalances that were left in here, tap into that order block, and then go. And the reason that order blocks are so powerful is because of this right here. And it has to do with, again, the big money movers, the market makers, the banks, the hedge funds, etc. Because, guys, again, like I said in the liquidity sweeps video, they can't just get in the market like we can. They can't just press buy or sell and that's it. They need to manipulate price in order to get the entries that they want for their positions, and again, to trigger money into the market. So order blocks in and of themselves, a lot of the times, are also another form of a liquidity sweep, right? Or it's proof that there was manipulation happening at that time. Because, guys, check this out. So, you know, we're right here, right? We already know that price ran up. It grabbed some liquidity. But then our order block is actually right here. And why this is an order block is because last up moving candle before the down move that broke structure, okay? So, boom, we already covered this in the break of structure video. But we know that this was our break of structure candle here on the 5-minute time frame. So that means this is our order block. Now, this order block is interesting because this order block not only, you know, was a continuation of this move that ran this liquidity, but it also poked above these highs as well. So the way you can interpret this, if you're analytical, is when the market makers, big money, etc., knew that they wanted to move price down, or the algorithm was ready to trigger in sells, the first thing that it had to do was actually buy the market up. Okay, so it had to buy the market up in order to get the entry that they wanted for their short positions. So as price comes down and we break structure, and on the smaller time frames, we also left behind a fair value gap, which we covered in the fair value gap video. That means the banks put in a buy order right here to push price up, and then as price came down, they're still holding the buy. So once price came down and broke structure, this buy position is now obviously in drawdown for the bank, for the large institutions, etc., right? So at some point, it doesn't have to happen right away. Sometimes it does, sometimes it doesn't, but at some point, they will need to bring price back to the open or the 50% of that candle before continuing to the rest of, you know, to collect the rest of the move, whatever direction that they're sending the market in, because they need to close that position out at least break even before they continue, you know, to the downside, correct? So, you know, the way that you could play this is to actually plan to take an entry off of the order block. Now, if there was a wick, you could include the wick if you would like to. And in many cases, I prefer to just trade off of the bodies. But if there is a nice candle, I'll mark the entire thing. But right here in this example, you can mark the low of this candle to the high of this candle, and you could plan to enter the trade right off of that order block, right? So you'd put your stop loss right above the high of the order block, and then again, you would target opposing liquidity, like right here. You would this fair value gap, this liquidity, so on and so forth. But we can go ahead and delete that, and obviously show you guys what happens. Price comes back on the very next candle, taps into that order block, and then sells off, right? So that is how you would play order blocks. And the best order blocks, the highest probability order blocks, guys, are going to be the ones that have, one, swept liquidity, and then two, also have an imbalance within them or leading right up to them. Now, obviously, we were looking at that example on the 5-minute time frame. So there wasn't a fair value gap left behind on the 5-minute, but as we covered in the fair value gap video, there was definitely fair value gap left behind on the 1-minute chart. So boom, looking at this, there was that fair value gap that we covered. It pulled right into that fair value gap, and then also tapping that order block and then sold off. So guys, you'll see these confluences coming together. That's why we're doing this one concept at a time, so you guys can really understand it and understand when we talk about confluence and looking for all these things in congruence with one another, confluence with one another. This is exactly what that means. Now, let's just say we were to go look at another example here, guys, and let's jump into replay mode. We'll just go from right here. Obviously, we have the benefit of hindsight if you're paying attention. But what do we have here again? 5-minute time frame. Here's the last down candle before the move that broke structure. I mean, it not only broke structure, this was the first one, correct? Because we pushed down, grabbed liquidity, right? We took this low, we grabbed liquidity, boom. This was actually your first break of structure if you were watching price right here. This is your first break of structure during PM session, and then price actually did come down. It did come down and touch this order block. This is the last down moving candle before the up move that broke structure. So that could have been an entry right there, right off of this order block. But then there's also another order block that we can pay attention to. So let me mark this quick so you guys can see it. So we'll mark this order block. Price came down, boom, and ripped. And you could have caught, a great risk reward on that. Like what is the risk reward on this? Let's just look. If you would have entered off the body of the candle, even if you used the wicks, right? But let's just say you used the body and your stop loss was below the low. It didn't obviously run all the way up to here, at least not from what we can see, but it did take this high. It filled this fair value gap, and your risk to reward potential was over a 1 to 5, almost a 1 to 6. That's an amazing trade. That's an incredible risk to reward. But now looking at this, if we just delete this to keep our chart super clean, let's mark this candle now. Here's our order block, right? Last down moving candle before the up move that broke structure. What's right above it? Fair value gap, right? So we got fair value gap right above it. Let's extend this out to the right. And let's see if this holds. Does this get respected when price comes back down into it or not? In the order block, boom. Rejects it. Comes up, sweeps liquidity, so on and so forth. You already took a partial profit probably right there at that high, right? And then you can ride it out from there and see where it goes. But that is what an order block is, guys. And then I'm going to clip this video. I'm going to add to it, and we're going to go over what a breaker block is next. All right, guys, in this video, we're going to go over what a breaker block is. This is going to be a really quick video because we already covered most of the meat and potatoes in the order block video, but all a breaker block is essentially a failed order block now being retested from the other direction. Okay, so if we were to just look at our chart right here, this is SPX S&P 500 on the 15-minute time frame, and we can see right here, where's our order block? Our order block is right here. It's the last up moving candle that swept liquidity during New York session right before the break of structure, right? The break of structure technically came on this candle right there, but price sold all the way off and obviously ran for opposing liquidity, which was those lows. And this was a valid order block. And obviously, one of the ways that you could have been anticipating this was that price would come up, respect the order block, and then sell back off. However, in this case, nothing is 100% first and foremost, but in this case, price runs up right through that order block and it just keeps going, right? So that's what happened, and this order block now becomes a potential breaker block in the future. And you can mark this just like you would mark your order blocks. You could include the wick if you so choose to, or you could just mark the bodies. That's going to be up to you. When it's nice candles like this without really, crazy wicks or anything like that, I kind of just like to use the bodies if they're really solid bodies. Now, if it was like a weaker candle like this where it's like half body, half wick, I'm just going to include the whole wick, the entire move of the candle. But it's really up to you guys. I mean, don't overthink it too much. It really is not going to make that big of a difference if I'm being completely honest with you. So here's how you can expect breaker blocks to behave and to react when you are now looking for your trades. Watch what happens here as price comes back down and retests that breaker block. You'll see price come down to the body and or 50% sometimes of that, and then obviously respect, hold, and move out of it, guys. So all a breaker block is just a failed order block being retested from the other side. Again, you're not ever looking to trade breaker blocks simply by themselves. You need other confluences in alignment with it, and here we go. Just to point this out to you guys really quick. Let's look at this. So you have price pushes down. What time are we in here? We're literally coming into New York session. New York session opened up 30 minutes prior to this. This is set to Central Standard Time. So this is 8:30 Eastern Standard Time, or New York time. And what happens? Price comes down. This was actually a news day, if I'm remembering correct. And price comes down and it sweeps liquidity, taps into this breaker block, and then just absolutely rips. So this was all things lining up with confluence. A liquidity sweep, breaker block, time and price, and then if we were to drop down in time, then that's when you'd be looking for your breaker structures or your fair value gap entry points on like the 1 minute, 2 minute, 3 minute. But that is what a breaker block is. It's very, very, very simple. Like I promised you guys, it was going to be quick and easy, because all it is a failed order block being retested from the other side, and it's only to be used as a confluence to add to your trade and nothing else.